Welcome to a Wiser Retirement podcast. Before we get started with the episode, I want to tell you about a new ebook available on our website called Buyer Beware. Why do they keep trying to sell you that annuity? This ebook covers the various types of annuities, negatives to owning annuities, and better investment alternatives to annuities. To download this ebook, you can click the link in the episode notes or go to wiserinvestor.com and you'll find it at the bottom of the page. Now on to today's episode.
Welcome to a Wiser Retirement Podcast, where we believe the best financial advice should always be conflict-free. I'm your host, Casey Smith. Guiding you to financial freedom today is my co-host, Brad Lyons. Hey, Brad.
Hi, Casey.
So today we're going to talk about, I guess, more recent news events. Silicon Valley Bank collapse.
Yes.
And let's talk also a little bit, I guess we'll start first with ESG investing, which if you're a regular listener to the podcast, you know that I think is a complete scam. Not because I don't disagree with ESG, nor do I agree with the ESG concepts, but more of the fact that it's the way for asset managers to collect more in fees at the expense of the investor. So let's talk about that for a minute.
Well, it's in the news because now it's become a much larger issue. It's gone through our political process through Congress. So it was simply a local thing, a choice by asset managers, but now Congress has gotten involved.
So what does ESG stand for?
Environmental, social, governance.
And the concept is that each individual company can have an ESG rating or ranking, I guess a rating really. And based on how they're doing on affecting environmental concerns, diversification on their board, things of that nature, right?
Right. That falls under governance, right? How they conduct themselves as a corporate citizen, essentially.
And this has been brewing for a while. Some people might say, you know, it's a firm going or a company going woke. That would certainly be the extreme side of ESG. But in this sense, you have to understand that every company's doing this. If you look at the side, the S&P 500, every company is focused on ESG criteria. So,
well, if we could stop there for just a moment, because what's come to light is that there are multiple criteria. There has not there's not a uniform criteria, and this is part of the problem.
Right.
Okay. It's like hockey. You know what they say about hockey? You skate to where the puck is going to be rather than where it is now.
Right.
Well, right now they're out there skating, trying to figure out where the puck is and where it's going to be.
So there's no real
there's no
refinement.
That's correct. There's no uniform criteria for ESG. And this is part of the problem. It's no different than an index itself. All indexes are created a little bit differently to create, uniqueness, to be different from the other guy, so to speak.
Right.
ESG criteria has its own unique patterns, its own unique nuances to it, depending upon who's issuing the criteria.
So you have to understand that I'm not a follower. I don't follow well. Never have, honestly. And so when things come out like this, you think, oh, ESG's, this is the future of investing. It's the future of how we're going to measure company success going forward. I'm pretty sure profits are how we measure success going forward, because if you don't have profits, you don't have a company. It goes out of business, right? So ultimately, we stayed away from this from the beginning as a firm. And it's here it is in a nutshell. If you buy the S&P 500 index, the ETF, VOO, IVV, pick your SPY, pick whichever fund you want. The ESG rating of that group of stocks is the highest, AAA. And it costs you 3 basis points, 0.03% to buy that fund. Trades for free. It's ETF. Then, if you go out and buy the iShares ESG large cap fund, which amazingly looks a lot like the S&P 500, has the exact same rating, AAA ESG rating, but yet it costs you 5 times as much. And that 5 times difference for the same amount of performance gives BlackRock $56 million more in revenue per year. So why do you think these big companies these big investment firms are all about ESG? It's because it's profitable for them. They make more money at it. You don't get any better performance. In fact, it's underperforming because a lot of the ESG funds are growth funds, or ESG companies are more growth-oriented companies, right? So now let's fast forward to current news, Brad. Actually, we have to start with old news first, because the old news is the Biden administration put into place, or I guess the Congress, that ESG could be purchased inside pension endowments, correct?
Yes. Congress,
and that happened a while ago.
Yeah, Congress, both the House and the Senate, passed a resolution law that allowed for to codify the fact that asset owners or decision makers of assets in public funds, in the public arena, could not utilize intangible criteria such as non-financial criteria to make an investment decision.
Right.
Okay.
Or I think it's more like they were liable if they used that criteria, correct? I believe that's how I originally read.
So essentially what they were saying is that they did not want boards of public pensions, public money, to utilize any other criteria other than financial criteria.
Makes sense.
To make a decision on whether or not to allow an investment in a public fund. So it passed both houses. It had both Democratic and Republican support. When it got to the White House, Joe Biden utilized his first chance to veto a bill. So in the first veto that he did in his administration happened on this bill, where he vetoed that for his own reasons.
Well, the Trump administration originally put it into place that they couldn't, and then now this is where they reversed it when they had full power, and now the House put forth the legislation, and I guess the Senate too, to get it all the way to the president's desk.
Well, the reason they had to do this in a legal sense is because it already exists in ERISA, the ERISA law. Public funds are not governed by ERISA. So they had to come up with new statutes, new laws to follow to guide public fund pension managers.
Right.
Okay. So they came up with this already in ERISA, that it's gone through multiple revisions, where first they could not utilize non-financial criteria. Then they could utilize it, all things being equal, they could pick either stock or either security. And then it went to another iteration in 2015 or so that said, well, if you're going to utilize non-financial criteria, it should be rare.
Right.
And then in 2020, they revised it and took that completely out and says you can utilize non-financial criteria when making investment decisions, but you better be able to back it up.
Right.
Okay. So in ERISA, it's allowed. Okay. But for public funds, they had to find a way to either control it or allow it. One of the two.
Yeah.
Okay. So Congress went with controlling it and eliminating it from decision making. The president vetoed that.
And so ultimately, if you think about it, when the law was first passed, I did on a Wiser Retirement, which is our YouTube channel. I did a short little piece about that, because in the past, if you're a business owner, if you're advising a 401k plan, and you were to add ESG, potentially you could be liable for adding a fund that's not appropriate because of underperformance, higher fees, et cetera, et cetera. What
if
that
you knowingly
correct
add it? Yes.
Correct.
Right.
So if the problem with then allowing it, they basically said, hey, you can put this in now, and you're not going to be held liable if it just blows up. And so my public service announcement was, well, don't be adding ESG funds to your 401k plan, or if someone does add it to your plan, avoid them, because they're more expensive. and you're not making any difference. You're not making any change by doing it. Just because you invest in companies that have a strong ESG rating, these are index funds. You're going to own everything. There's even things in ESG that people who are purists argue that shouldn't be in the fund, right? So ultimately, you're increasing your costs at no benefit, and you're not making any difference in the world. If you want to make a difference in the world, vote, protest, write letters. Those are all things that could potentially make a difference, but not sacrificing your retirement money.
Right. Social investing has been around for a lot longer than ESG. ESG is a second or third generation of social investing. Social investing, or socially responsible investing, it was called, came on board somewhere around 1970s and 1980s. Some of the early funds were
severe underperformance.
Yes, they were. They were at the time. Well, that was the first iteration. They were trying to figure it out. Some of the first funds, Calvert Social Investments,
right.
Ave Maria funds, if you recall those. A lot of this came out of charities, hospitals, and faith-based organizations. Actually, were the ones that were asking for it, and managers responded to it by offering these new funds. But they've been around for quite some time, and there was no laws governing it. Okay, whereas in ERISA, in the private sector, the ERISA governed it. Without an ERISA law for this, public funds, hospitals, publicly funded hospitals, were able to do this at their will. And it kind of makes sense. And if you were a hospital and you were a publicly funded hospital, what they often did was eliminated, quote, sin stocks. Those were a term from back in the 80s that, we don't even refer to today necessarily. But the sin stocks, the original sin stocks, were tobacco, alcohol, firearms, gambling,
right?
Things like that. Hospitals really didn't, in their opinion, want to be involved with a gun manufacturer who created and produced firearms that were used to injure people that they had to put back together in the emergency rooms. And this is the way they were thinking.
And that was back in also a time period when there was more concentrated positions held.
That's correct.
Where most people today are buying the S&P 500 or index funds.
Right. The indexes funds barely even existed back then at all.
Correct.
So they were so new. And so what they were telling their investment managers, just avoid these stocks. So you have no other way of knowing, the good, the bad, of them, the relative nature. So just avoid them completely. Public funds went in another direction during that time period. What they were trying to do was match the demographics of the asset managers with the demographics of their region, their location, their state, their city, et cetera. So a city could have 3 different public funds that could be involved in something like this. They could have the general employee pension fund. They could have the firefighters pension fund. They could have the police officers pension fund, plus their defined contribution plans, their 457, accounts as well. So they were making decisions based upon the demographics of the fund managers relative to the demographics of their location. So they've been involved in social investing for a long time as well, trying to push forth. No different. So they were letting a contract that they had subcontractors had to be either minority or they had to be local, et cetera. Okay. They were saying if money is raised locally, that money was going to be spent locally. So they've pushed forth this agenda for years as well. It's evolved into an ESG, the environmental social governance. Now it includes inclusion and worker rights and some of this other thing that's going on. And so it's just become so convoluted that what is happening in the public arena is that the decision makers may or may not feel the effect of any mistakes that they make. So you have a board member from a public fund, okay, that may or may not be participating in the retirement plan or the asset, that they are making a decision on. So they've separated these two aspects of decision making and actually feeling the benefit or that or consequent of that decision. And so they're without tying it together, okay, where they are intrinsically involved in the decision and therefore good, bad, or indifferent, they participate in that decision as well. Okay.
Yeah, well, that's back in a period there's more concentrated stocks, where today it's just an agenda. It's almost like
It is very much an agenda.
it's a political.
Oh, absolutely.
It's a political agenda in the South. I've never had a client ask me about ESG. We've had several clients tell us they don't want to hold BlackRock in their portfolios, right? And kind of in retaliation to the whole ESG push. What I'm saying is ESG is here. It's real. It's being adopted by, if not all 500 companies in the S&P, 499 of them.
Yes.
And so why would you pay a premium for something that's already being adopted and you don't need a screen?
Exactly. And that is the point, that literally when they're screening, they're not completely eliminating. They're just weighting, underweighting and overweighting. Because like you said, you look at the top 10 holdings, or you look at the sector holdings, they're almost identical within a percentage point or so of weight. Okay?
So then the argument from the ESG community is that these stocks will perform better because they are ESG. These are more forward-thinking managers. That doesn't apply either. There's no outperformance.
It's very subjective, quite frankly. The theory is that in an efficient market, if a company's stock is affected by its shareholders that are choosing to or not to invest based upon ESG criteria, if there is an event in that stock, then other market participants, other investors would go in, okay,
right,
and swoop into that stock, okay, buy it, raise the price up, and they're going to take advantage of any thing that happens. So it's hard to tell whether or not this occurs. You look back in history, there's a couple examples where the investors have tried to change a government, change a country, change an industry, and it's pretty much failed every time. Remember years back we had the whole tobacco industry, settlement. People are still smoking. They went after it. They charged them. They had to pay every state hundreds and hundreds of millions of dollars.
Right.
People still invest.
People
still smoke.
Yeah, that's true.
They just don't change people's
not as much
behavior.
as in other countries, but yes.
Another huge one is South Africa. The whole world was banned, pretty much from investing in South Africa. They banded together and says, we need to change this regime.
Right.
Okay. Not much has changed.
Right.
Currently, in the U.S., you cannot invest in Iran. Okay. Yeah. Other countries still do it, though. Yeah. We haven't changed Iran one bit. So it's very difficult to change a regime or change a behavior by how you invest, to your point.
Yeah. Well, in some sense, from a corporate standpoint, if you weren't doing these things, it might be harder to get loans. It might be harder to do business with other companies because you don't fall into an ESG criteria. And we're not talking about that. We're talking about specifically you as an individual investor. Does buying an ESG fund change the world? And my take on this is, and I think it's the right one, is the only thing that changes is it takes more money out of your pocket and puts it into big management. That's the only thing that really changes. You might feel better. And I got into a debate with another advisor one time about this. She was very pro ESG. And in the end, that's what the debate ended. She says, well, I do this because it makes my clients feel good. And I just responded with, my job is not to make them feel good. It's to tell them the truth, allow them to make the best decision possible. Now, that typically ends in a feel-good scenario on the other end. But if my job was to tell them that they all felt good, I'd say, yeah, you're all ready for retirement. Let's go. That's not the role of a fiduciary advisor. It's this is the data, this is the truth. And so the truth, it's much like low volatility funds during the financial crisis. Everyone started buying up low volatility funds because that was the latest and greatest thing because there was a lot of volatility. In the end, the low vol stocks ended up being more volatile than the S&P 500. And so you have to be careful of this bandwagon approach and movement. And fear will move you. Also, I think sometimes maybe good feelings move you, and maybe ESG is part of your personal cause. And so having ESG in the name is makes you feel better. But in the end, I'm telling you, it's a false sense of security. You're not making a difference. But do you think that the only reason this was vetoed is because politically it sounded bad, or they just don't know either?
Well, that would be subjective, but I have to say yes. I think that it was politically motivated for him to veto it. The first bill passed after Republicans took control of the House.
Right.
It was the first bill.
Yeah.
Okay. So yeah, I think it was very much politically motivated, and he's pandering to his base, which is fine. That's what politicians do. It's the only bill he's vetoed, but then he had control of both houses of Congress prior to this, so he didn't have to veto anything.
True. Well, it's definitely very. It shouldn't be politicized because numbers don't lie.
Well, here's some numbers. Energy has been the best performing sector for a couple of years now, right? Since January of 2021, the energy sector, XLE, representing the energy sector, up 133%.
Which, oddly enough, actually does have a really big ESG rating because they invest in all these, right? It's you can manipulate the scores. I mean, you go look at ExxonMobil, people. Look at ExxonMobil. They're like the highest rated ESG ranked fund on the S&P 500.
Talk about that. Elon Musk's Tesla has been kicked out of. It got kicked out of the index,
right?
And he goes, but Exxon's still in it.
Yes, exactly. Yeah. Well, it's because they're investing in renewable energy, right? So all the damage that they cause, they get to invest in other things that gives them a positive rating. It's like Delta Airlines. Delta Airlines has a very high ESG ranking because I guess they're going to plant enough trees to offset their carbon footprint or something like that, right?
Well, they can look at trends, and this is the thing that frustrates, I think, business managers. Instead of it being an absolute, it's more of a trending thing. But so energy is up 133% since January of 2021. IVV, the S&P 500, 10. XVV, which is the S&P 500 that utilizes USG rankings, is up 7. All right. So that, and XLE energy has a 5% weight in the S&P 500. So now it's not a direct correlation, but it is certainly a correlation that XVV at 7% has a lower weighting than IVV, which has the full weight of energy in its index, and it's underperforming. Whereas energy itself is up 133%.
And actually, I stand a little corrected on ESG rankings. So ExxonMobil has a ranking of 36.2, and normally you want to be something north of 70. So it is ranked. It is ranked lower, but ultimately, well, of course, here's the problem. That's one ranking metric, which I'll go unnamed, but there's also other ranking metrics that would rank them potentially higher. It's also, as part of the S&P 500, ExxonMobil is a pretty small percentage now, where years ago it used to be very high.
Yeah, the entire energy sector is it's only 5 or 6%.
Right.
Whereas 2011, it was the largest weighting in all of,
which again helps
the S&P 500.
It supports the S&P, in that you do own it, but it's a small percentage right now, unless energy has a big rebound, I guess.
Well, here's somewhat of a prediction for this. Now that factors that are non-financial can be considered for inclusion in decision-making by public funds. We've talked a little bit about this in the past. It's something that's coming on into this areas that the direct indexing.
Yeah. Right.
Okay. You take a company, an asset manager that can perform direct indexing on a very low cost basis now. They can go in and pick and choose any company or stock that their asset owner, that they've been hired to manage money for, be it the public fund, the hospital, whomever, and just eliminate any company they want because they can consider non-financial. Right. So they don't even have, in time, each company, each asset owner, each fund can make up their own criteria.
Yeah.
And hire somebody to manage it for them.
And there's certainly nothing wrong with that. I just don't want listeners to think that because you buy an ESG fund that you're making a difference. B,
right.
You have a higher rate of return. Historically, that hasn't been proven.
Right.
Anything else to add there, Brad?
No, interesting topic. We'll continue to watch. Okay.
Follow the money. That's something I learned a long time ago. You want to see how something works, follow the money.
Absolutely.
I will add that if you add, you look at ESG and its promotion and its bills, who's in the government right now, and where are they from? Look at the people who are in charge right now. A lot of them are from BlackRock. They're holding public office, and when these bills pass, supporting ESG and these funds, the use of these funds, who's the biggest beneficiary? BlackRock. Follow the money.
Well, who's some of the largest shareholders in these publicly traded companies?
Yeah.
BlackRock.
Yeah, that's right.
So they have the largest vote.
That's right. Yeah, that's a whole different podcast. But you could argue that BlackRock and State Street, some extent Vanguard, not as much as the first two, control a lot more than what you think. Very interesting. All right, let's talk about bank collapse. SVB.
Silicon Valley Bank.
So, not to be confused with SBF, the fraudster in the crypto world.
Right.
But SVB. So, I guess Brad just kind of walked me through this. We wanted to get on top of this really quickly. So, we did a video last week or 2 weeks ago for our YouTube channel at Wiser Retirement. But there's been more developments since then. So, I guess first of all, should we be concerned as depositors in smaller regional banks?
No.
What happened in this bank then?
Well, this bank had a couple things occur. As I was thinking about this the other day, it was almost like a perfect storm. Okay, a white squall, as a sailor would call it.
Right.
A perfect storm had occurred. The first thing that occurred was that over a number of years, interest rates were held very, 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 very low. Okay, giving asset owners the ability to go out and extend the duration of their fixed income bonds that they would buy in order to get some return on it. But they didn't have to pay much to depositors because interest rates were so low. So whatever they were able to earn on the securities that they invested in, long-term treasuries in this case, they kept most of it. So it was very profitable. But they were investing in the world's safest securities. When they had extended their duration for a very long time, duration is how long they expect the bond to last until being called. That's one thing. The second thing that happened was interest rates began to rise. And they began to rise very quickly in 2022. Mm-hmm. They rose from 0 to 4.5%, I believe, okay, which was unprecedented. Okay. We all know the relationship. The relationship is tried and true. The relationship between interest rates and bond prices. As interest rates rise, the price of bonds falls. As interest rates lower, price of bonds rises. Okay, it's a direct relationship, has existed for a very, very, very long time. So as interest rates rose throughout the year, the value of those bonds that the bank managers had invested in with depositors' assets at Silicon Valley Bank, the value decreased, went down. Okay. Now, they had told the regulators in their financial statements that these were securities that they planned to keep to maturity, and therefore they didn't have to mark them to mark to market. Thank you.
Yeah.
They could hold them at par value. Depositors that were concentrated, their clientele, so that's the other thing. So the third thing is that their deposit base and their clientele base was highly concentrated in Silicon Valley. And that's two things. That's technology, venture capital. These two groups began to get concerned about the viability of Silicon Valley Bank. Silicon Valley Bank had gone to the markets and said, we want to raise capital. And instead of assuring depositors, reassuring depositors that the bank was safe, that actually caused the depositors to be concerned that maybe the bank wasn't safe. So depositors began withdrawing money at huge sums. One, because they were burning cash. technology was going through a bit of a slump last year, and venture capital was using up the reserves that they had garnered from investors. And so they were withdrawing money throughout the year. But then as interest rates continued to rise, and Silicon Valley Bank went to the markets and tried to raise capital to shore up their position, in one day, depositors withdrew $42 billion in assets. Deposits.
Fed by Twitter.
Yeah, exactly.
Twitter was the catalyst for
It was
that.
essentially a bank run on social media.
Good old classic bank run. Just like, what was that movie? It's a Wonderful Life?
Wonderful Life.
Yeah.
We could bring that up a little bit.
just
How
like
banks
that movie.
manage their assets. So in order to meet the demand of those withdrawals, they had to begin selling these assets that they said they wouldn't sell. They began selling them at the loss. And ultimately, they lost $1.8 billion on these assets. The regulators found out about this. They swooped in, literally, and closed down the bank in one day. They went in on March the 10th, I think, and over the weekend.
I'm sure management
They closed
was
it
like,
down.
what the heck just happened?
Exactly. It happened so fast. So those three things, okay? Low interest rates, rising interest rates next,
Yep.
concentrated
Portfolio.
of clients. So
Yep.
all these things came together, and the bank went under in one weekend. The same thing happened with the Signature Bank in New York. Exact same thing.
Yep.
They had all three aspects. They had, again, that highly concentrated client base. So as such, the regulators went in, took over the bank, created a new banking entity that they could move all the assets to and all the deposits to. The government stepped in and said, we're going to insure all deposits, even those over $250,000. Now, the reason they did that, because a lot of these depositors, over 80% of the deposits, were well over $250,000. This was a bank that banked corporations. People had accounts there too, but mostly corporations.
What's interesting is over the last week, I had a board meeting, a board up at Berry College up in Rome, Georgia, and one of our board members has started a company that invests funds for nonprofits, and she was telling me that they actually banked at Silicon Valley Bank, and they were like kind of reading what was happening. He said, we should do a withdrawal. We maybe won't take all of it. Maybe we'll take some of it. Eventually, they said, okay, we're just need to get a lot of chunk of it. They ended up missing a payroll because they couldn't get the money out. They didn't have to do. I think they had reserves elsewhere, but she said that they missed a payroll. Quickly were able to get back on their feet. But even to this day, she's not unable, at least as of last week, was unable to get the full amount out. They were kind of letting it go out very slowly, I guess.
Right. They were receiving something called a certificate.
Correct.
Yeah.
And then she says now she gets emails advertising the bank saying, hey, put your money back in here now. We're safe. We're backed by the FDIC. You know, we're under new management. We're going to do things differently. And so now she's being encouraged to put the money back in. I'm like, I don't know. I think I would just kind of walk away. Hence now the bank was just who was it? First National?
First Citizens
Or
Bank.
First Citizens
Bank
right.
out of Raleigh, North Carolina, interestingly enough.
Now, did they purchase the whole bank or did they?
They purchased all the loans and all the deposits.
Okay.
So essentially, yes, they had. They were able to buy all the loans, which are considered assets at a bank. You
Right.
know, they were considered on 70 cents on the dollar.
Great for them.
Yeah. This is a bank that has gone through a number of acquisitions over the years, and FDIC, Federal Deposit Insurance Corporation, was very comfortable with them, and they won the bid, and they received permission to purchase all the assets without having to purchase any of the assets of the treasuries that we talked about. Okay, so they were able to leave those behind. FDIC Insurance Corporation is going to continue with them
Right.
as assets of their own. In the end, FDIC expects that this will cost their reserve fund about $20 billion.
Wow.
That's all going to be paid for out of the Deposit Insurance Corporation fund. But
Which people pay into, banks pay into that.
Yeah.
So in the end, surely there was tax dollars paid for some of this in the end. Yes.
They're claiming no.
They're claiming no.
Right.
Okay.
Yeah. So, but the function of banks, to go back to the movie analogy, Wonderful Life. Remember that scene where there's a run on the bank,
Right?
And one woman asked for, "Can I get my $2 out?" And she goes, "Well, it's not here. It's in so and so's home mortgage, and it's over here in so and so's mortgage." So that's the function of banks. They take dollars in as deposits and then lend them out, in form of loans to spur economic activity.
So if everybody went to the bank asking for their money, there is no bank that would be able to pay all the
That is correct. That is correct. And that's the point.
Yeah.
Okay.
So if you all go running at once because you get freaked out because you saw something on Twitter from your buddy who runs another venture capital fund, this is what happens, right?
Yes.
So will it happen?
There's been a number of people who have criticized the FDIC and the government for essentially propping up an insolvent bank. They just say should have let it go completely and not protect the depositors. It could be that they have their own bias. It could be that they remember the great financial crisis when other organizations did go under,
Lehman, right.
for example. So we don't know exactly what their bias is, but Silicon Valley Bank was buying the safest securities out there. They just mismanaged their duration on these bonds.
Well, and then they were all reading the same headlines. I mean, why wouldn't they? With a position that large, you could probably afford to hedge those treasuries somehow. And
right.
Yeah. So I don't know. I've seen interviews from all different sides, or I guess really two sides. But they really seem to be kind of blasting management as basically rookies, not really well versed in banking. So there could be a little bit of that, and then there's also could be, well, you know what? In 2021, the Fed said we're not going to raise interest rates. We're not going to raise interest rates, and in January of 22, something happened. The light switch got flipped, and
there was the famous statement by Jerome Powell: "We're not even thinking about raising interest rates."
I was using one of the articles too, I think. So to their defense, the world changed very quickly. But
yes, it did.
But at the same time, when you're in a business, you have to be able to adapt. And other banks seem to be able to adapt just fine for whatever reason.
And that's why I answered your question, or should we be concerned about all the banks out there, depositors? Well, I answered no. Again, there was three unique things that happened. Other deposit organizations, banks, credit unions, savings and loans have a much broader, diversified clientele base. They're not so heavily invested in one sector. Should that sector go bad and everything else fails, it's like dominoes would drop. Okay?
Correct.
In a broadly diversified bank customer base, one sector may not be doing as well as other sectors at any given time, but it doesn't affect the entire deposit base at the bank.
That does lend to the thought that your large, too big to fail national banks are probably the safest place for your money, though, because if you remember back in the financial crisis, we had a lot of banks go under because they did real estate lending all in one particular geographic area that all defaulted, right? Or they held those, they had packaged loans and sold them out that were essentially worthless, things like that.
Right.
I remember banks that just really focused on builders, like when they stopped building, and all of a sudden builders are in trouble. Well, if you did most of your business with builders, you also had an issue. So it'd be interesting to see if there was a report that would show at regional banks, our lending isn't across these industries. But I don't know that there is, at least for the public to see. Maybe the FDIC gets to see that. I don't know. But I don't,
Yeah. We're as consumers, we're left to do our own due diligence on the bank that we choose. And what we can, as individuals, we should talk about this, Casey. As individuals, if we're married with a spouse, we can, insure up to, I think, about $1 million at any one bank, depending upon how we register our accounts at that bank.
Yep.
And so there are ways to insure ourselves. Okay, there are ways that if you have more cash than that at a bank, that you should look at diversifying your banking relationships.
So your FDIC protection's up to $250,000. If you have a joint account, that'd be $500,000.
Right.
Right.
And if
you have a
each have
trust,
individuals,
each individual is another $250.
Yeah.
And then if you have a trust, that trust could hold $250 on its own as well.
right?
Or
And then
more,
IRAs
actually.
are unique as well. So you can insure quite a lot at a bank before you need to diversify.
Right.
Yeah.
Your banks. Yeah.
Correct. Yes.
All right, Brad, thanks for researching that for us. And we have other videos, Investing Through Times of Fear. Man, this was one of our biggest downloads in recent history, episode 154, Investing Through Times of Fear. Take a listen to that. Also available to watch on our YouTube channel. You can also look for that, what you need to know about the Silicon Valley Bank failure. We really talked about it here, but if you wanted to see Brad and me, and we threw it together really fast. The lighting is even quite right on that video. Stay invested long-term is another one you might want to search for on the website. Also, we have a new ebook, Buyer Beware. Why do they keep trying to sell you that annuity? The link to download is in the episode notes or at wiserinvestor.com. In investing in times like this, the salespeople get out there and they love pushing expensive products that you don't really need that benefits them and their family and their company, but certainly do not benefit you. And that's one of the things we're seeing. I'm starting to see an uptick on that on Facebook as well. People advertising annuity-like questions. They're not saying they're selling annuities, but they're being very slick. Thanks for listening to today's episode. If you're interested in learning more about Wiser Wealth Management or want to schedule a consultation to meet with one of our fiduciary financial advisors, you can do so by going to wiserinvestor.com, or you can click on the link in the episode notes. Thanks, Brad. See you next week.
You bet, Casey.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening. That way you don't miss any new episodes. We'd also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. This episode was produced and edited by Ken Hoadley.